But in the markets, the real news is going to be about JPMorgan. Those earnings out just a few moments ago. A beat on the top and bottom line, David. What I found interesting, though, is that FICC, $4.5 billion. Big beat, almost doubled from the quarter before. Equity is good, but it was investment banking that seemed to be weaker.
Yeah, and they were projecting trading being up, but not as much as it was, actually. They were up 7% overall when you take everything out. So they really had a very robust. At the same time, there was a little bit of a miss on investment banking, which surprised me a little bit.
Fees were lower, and also you wind up having revenue lower as well across the board. All right, for more, here's Alison Williams, Bloomberg Intelligence, senior U.S. banks analyst. At first, the stock was up over 1%. We're off a little bit, losing a little bit of steam. What was your biggest takeaway so far?
So far, so good, I think. As you said, trading coming in better than expected, fees lighter. I think volatility explains both of those things. Volatility is good for trading. It's not good for the underwriting business, although the outlook there is still constructive, so we're going to want to hear about the outlook on the call. Core loan growth, ex the investment bank, 8%. That looks great. And I think, again, that's a positive read-through for the economy. We're going to see what Wells has to say. Obviously, they have some constraints on their balance sheet, and Citigroup is sort of has a different mix. So I think this is probably the most indicative in terms of macros. Also, looking forward to hearing some more comments. If we look in the release, you'll see that they did sort of map out some initial reactions to some of the proposals that we saw this week. Those are a big deal, I think, for the U.S. banks, and that's going to be something we're going to be looking forward to hearing more detail on.
There also is an emphasis, Jamie Dimon emphasized how competitive the lending is. What's going on there? What's the competition? How's that going to affect their business?
Well, I think that when you get slower demand and you have healthy banks and a lot of capital, you're going to get more competition. So we have been seeing competition in commercial lending for quite some time. Commercial real estate lending is another area that has sort of heated up. And again, we still are seeing some pretty good deposit growth. That means they sort of have more money to put to work.
I also want to point out net interest income is up by 10% to $13.3 billion. Can that kind of thing continue? At what point are they going to have to raise deposit rates? We've seen that, say, for wealth management and asset management, but not for retail.
We have, and I think that is something we're all watching. It's something we're going to be watching this quarter, but it's not something the banks are going to, I think, talk about in advance. It's something that you're going to sort of see later on. A lot of the competition is expected to come from sort of the traditional non-bank lenders. We have more transparency with the internet than perhaps we've had in the past in terms of people being able to see what competitive rates are. So we are expecting that. But in the near term, the loan growth that I spoke about, that's important in terms of helping to build a healthy margin. It's good for their mix. And I think, again, we're going to want to hear more about the yield curve, more about what they are seeing in terms of the deposit pricing landscape when we listen to the comments on the call.